All right, welcome back everyone. So glad to have you here for our deep dive into the CanSlim system. Today, we're jumping into part 5 of our 8-part series, and we are focusing on one of the most important letters of all, the S. Let's get right to it. You got it. S stands for supply and demand. This is a huge one. We're breaking down a core piece of what is, without a doubt, one of the most successful, statistically backed stock selection systems ever developed. And it all starts with a simple economic idea you already know.
So let me ask you a kind of weird question to get us started. What on earth does the price of beef at the grocery store have to do with finding a stock that's about to make a huge move? I know, it sounds a little random, but the answer really is the key to this whole thing.
As the man himself, William J. O'Neill, said, this is pretty much a universal law of how the world works. The same simple force that decides what you pay for anything, how much of it is available versus how many people want to buy it. Well, that exact same powerful force is what can cause a stock's price to absolutely surge.
Okay, so let's tackle the first half of that law, supply. When we're hunting for those real superstar stocks, it turns out that less is almost always more. The number of shares a company actually has out there for people to trade is a critical piece of the puzzle that, honestly, most investors just completely overlook.
So what do we really mean by supply in the stock market? It's simple. It's just the total number of a company's shares that are floating around on the open market. Think of it as the store's inventory. Some companies have a massive inventory of shares. Others have a tiny one. And that difference, well, it changes everything.
On one side, you have these mammoth, big-cap companies with, hundreds of millions, sometimes billions of shares out there. It takes an absolutely insane amount of buying to even make their stock price twitch. But on the other side, you've got these younger, more innovative companies with a much smaller supply of shares. When the big money starts pouring into these stocks, there's just not enough to go around, and that price can get squeezed higher way faster. So the goal is to find situations where that supply of stock is already small, or even better, it's actually shrinking. So how do you spot that? Well, you want to look for companies that are actively buying back their own stock. They're literally taking shares off the market. You check to see if the management team owns a big slice of the pie. They're probably not selling. And you want to be a little cautious of companies doing these huge stock splits, like a 5-for-1, because that just floods the market with more supply.
Man, this quote from Charles Tandy just says it all. This is a CEO who got it. He saw a market downturn not as a crisis, but as a golden opportunity. He'd literally borrow money to buy up his own company's shares on the cheap, masterfully reducing the supply and just coil in the spring for a massive move when things turned around.
And listen, this isn't just some nice theory. This stuff works in the real world. Just look at these examples from O'Neill's research. Teledyne chopped its share count from 88 million all the way down to 15 million, and the stock went ballistic from $8 to $190. Metromedia, Tandy, it's the same story. Spectacular gains after they got aggressive about buying back their own stock. That is the raw power of a shrinking supply. Okay, so a small or shrinking supply is a powerful ingredient, but it's only half the recipe. To get that truly explosive move we're all looking for, you need the other side of the law to kick in, and kick in hard. We're talking about demand. And not just any demand. We're talking about following the big money. We are on the hunt for what's called institutional demand. These are the giants, the whales of the market. Mutual funds, pension funds, huge banks. They have billions and billions of dollars to manage. When they decide they like a stock, they don't just dip a toe in. They buy hundreds of thousands, if not millions, of shares. Their buying is the rocket fuel that launches the biggest market leaders. So the big question is, how in the world do you know when these giant institutions are quietly starting to buy up a stock? It's not like you can call them up and ask. The number one clue, the absolute clearest footprint they leave behind, is a massive, unmistakable surge in the stock's trading volume. Take a look at this chart. This is the classic signature of institutional buying, what we call accumulation. See how the stock price is breaking out to new highs? Now look down at those volume bars at the bottom. All of a sudden, they are gigantic, maybe 50, 100, even 500% higher than the average daily volume. That is not your cousin Eddie buying a few shares. That is the unmistakable sound of big money pouring into a stock. So let's put it all together. Here's your checklist for a perfect essay setup. You want a company with a relatively small number of shares out there. You want to see that management has some serious skin in the game. You love to see the company itself buying back its own shares, shrinking that supply.
And then the final confirmation. You see those huge spikes in volume on the days the stock is moving up. That's the magic combination.
All right, you've heard the theory, you've seen the proof. Let's do a quick little quiz to make sure these concepts really stick. You ready?
First question for you. True or false? A company announces a big 5-for-1 stock split. This is a great sign for the stock's future, right? Go ahead, take a second and think about it.
The answer is false. It's a common trap. While it might seem good on the surface, O'Neill's research showed that these huge splits dump a ton of new supply onto the market, and that can actually put the brakes on a big advance, making the stock feel heavy and sluggish. It's a classic case of creating too much of a good thing.
Okay, next up. What is the single most important, most reliable sign that the big money, the institutions, are buying a stock? Is it A, a bunch of positive news articles, B, a high stock price, or C, a massive increase in trading volume?
The answer is C, and it's not even close. News can be noise. A high price can mean anything. But a huge surge in volume on days the stock is climbing higher, that is the clearest evidence you will ever get that the smart money is moving in and backing up the move. Volume, my friends, is the market's ultimate truth serum.
Great job on the quiz! So that, in a nutshell, is the S in CanSlim. It's all about finding that perfect storm where enormous demand from big institutions collides with a very limited supply of stock. And next up in our series, we're going to build on this foundation when we tackle the L.
Hey, if you want to master every single letter of this incredible system and really learn one of the most statistically proven methods for navigating the market, do yourself a favor and hit that subscribe button so you don't miss any part of this series.
And you can actually jump to the next part right now. Just click the link you see on the screen for a detailed explanation of the L in CanSlim, which stands for leader or laggard. You're going to learn how to tell the true market titans apart from the pretenders that will just break your heart. Thanks so much for watching, and I'll see you in the next one.